Welcome, everyone. So thank you for joining us this morning. First of all, just wanted to start off by honouring the traditional custodians of the land, the Wurundjeri people here in Melbourne. I'm mindful that we're going to have people joining from not just the rest of Victoria, but the rest of Australia as well. So welcome, everyone. We will be chatting today about information for first home buyers, what you need to know to get into the market, to know what your purchase price is going to be, and also information for parents wanting to help the children, what kind of levers we've got, what kind of support we can give, how that interacts with buying the property and also getting finance. We're going to start off today. I'm very aware that, having gone through the process myself, one of the big questions, one of the big unknowns is when do I buy? You know, there's so much information out in the media, so many opinions saying the property market's going to take off, the property market's going to tank, it's not going to do anything for 12 months. I know as a first home buyer, you worry, should I be bidding now? If I don't throw my hand up this weekend at auction, am I going to be priced out over the next month or so? Should I wait? Should I save up some more? Is the property market going to be more favorable in a few months' time? We're going to start the talk off today with our guest speaker, Michael Yardney, going through the market at the moment, what we think it might happen in the future, the different factors that are influencing that, try to make some, there's no answer to those questions, but at least we can arm you with some knowledge to try to help make the best decision there. From there, Michael and I will jointly speak about the different levers that we can pull. So the options that we've got for parents to help their children, different implications, the positives and the cons of doing that. And from there, I'll speak more directly about the information that goes into buying and getting a loan as a first home buyer. So the income question, the cash deposit question, how those two interact with each other and how they can then influence the purchase price we've got, and also influence each other, what ways that we can try to get the best from each of those. So firstly, myself, Brett Elliot, I'm a principal here at Wilson Pateras. I'm a mortgage and finance broker, been in the industry in various capacities for about 14 years now, looking after all different kinds of lending, all different kinds of clients, but most recently been at Wilson Pateras for about 2 years. And there's a wide range of things we do here at the firm, but certainly one of the things that I enjoy most is helping people get in that first kind of foot in the door in the property market. Our guest speaker, Michael Yardney. So we've got a very, very esteemed, highly esteemed guest today. Michael founded the Metropole group of companies. He's become one of Australia's leading experts in wealth creation. He's authored 9 books, 9, probably more than my dad's read, I think. And he was voted Australia's top 50 most influential thought leaders. So it's great that we've got Michael's time today. So firstly, a huge welcome and a huge thank you for joining us, Michael. And please.
My pleasure. Right. So should we get going then? I've got a few things, a quick disclaimer, as we always have to do. We don't know your personal information, so this is general advice. And of course, if you want specific advice, Brett and the team at Wilson Pateras or my team at Metropole will be more than happy to help you. But we've got to say that first, of course. Okay, what's happening to the property markets? That's what everyone wants to know. And the Melbourne property market has underperformed. We're basically talking about Melbourne today because the majority of people are going to be interested in that. But this shows the cyclical nature of property. 2020, you remember we had that COVID, and then all of a sudden the market dropped a bit. And then afterwards, despite everybody saying no, prices can't go up, you can see that each state had a boom in 2021, and then interest rates started rising in 22 and the property values dropped. And then state by state, they've all gone up, but have a look at Melbourne. It's been a bit of an underperformer and still has not reached its previous peak of March 2024. But the next slide is going to show you that this is not unusual. What actually happens, Christine, if we could move to the next slide, please, shows that the property markets move in cycles. If you have a look at Melbourne, a number of you will have been in the market long enough to remember the recession we had to have in the 90s. In the first decade before that, when the Real Estate Institute of Australia, the Australian Bureau of Statistics, started measuring numbers, Melbourne showed 14.4% growth per year after year for the 1980s. And then we had the recession we had to have, and property values dropped, but still went up a bit. And then a number of decades of average growth of 8.4%. And now the last couple of years, it's gone down. But look at every state. That's the way property cycles work. Each boom leads to the next downturn. Each downturn isn't a crash because it doesn't go below the previous peaks. It's just some areas flatten out, some areas go down in value a bit. But there's always something called reversion to the mean. If Melbourne's property values have grown over the last 45 years by about 8.4%, over the long term, they're going to get back to that. So I see a window of opportunity for those looking at Melbourne. Melbourne property market will end up this year a little bit stronger, probably grow by another 2-3%. But the next chart shows why I believe that's going to happen. What this shows is Melbourne's value relative to other states. Melbourne's always been cheaper than Sydney, but if you compare it to Sydney at the moment, it's 50. This is the median price. There is not one median property in Melbourne. There's not one Melbourne property. You are not going to buy the Melbourne property market, but an individual property in the market that suits your purposes. But the point is that Melbourne is now 57% of the Sydney median price, when normally it's around 74%. The gap cannot remain as big in the now what's interestingly the biggest state in Australia population-wise, as they've changed the boundaries, considering that we're getting a lot of migrants in as well. But basically, compared to other states, Melbourne has underperformed, and it will get back to the averages. The next slide actually shows one of the reasons why. We're getting significant population growth, migration. I know there's talk about the undersupply of properties at the moment and the housing crisis, which we are genuinely experiencing. And both sides of government have said, hey, we'll slow in immigration a little bit. Whether they do or not's another story, but currently we're getting a whole lot of arrivals, more than we ever had, and Melbourne is getting more than its share. But the next slide actually shows that what's happening is who's coming. We're getting more people in working age. Australia is bringing in migrants with skills, not skills that we can't provide in Australia at the moment. And these people are coming with money, with ability to get a job straight away. And what's happening is that for the first year or two or three, they rent. And so there's going to be a huge surge of buyers in the next couple of years as all these new people coming to Australia have the same aspiration as Australians. They want to buy a home. That's one of the reasons they're coming to Australia, because of our great country, because of job opportunities and the ability to buy homes. Often these people, and many of them are from Asia, a lot are from India, are happy to live in apartments. That's the way they've lived back home, and many in multi-generational households. But there's a huge surge coming in the future of these people. See, when they come to Australia, what do they know? They know where their job is or where the university is. They know where the opera house is, but that's about it. So they start to move into locations where their community is or where the job is. They find their feet here, and then they get into the property market. So what I'm suggesting is, moving forward, there's going to be a significant surge of property purchases. And the next slide shows how there is a huge undersupply. In the 50 years I've been in property, I have never seen such a deficit. So we're not building enough properties. And part of the reason is it's just too expensive to do so at the moment. The cost of land, the cost of construction, the cost of putting a project together, the market isn't prepared to pay that yet. This happens at this stage of the cycle. As the cycle moves on in, values will rise, developers will get into the market, but at the moment, it's not financially viable to do that. But the next slide shows how big our population growth is. As a percentage of proportion of our population, we haven't had population growth at this level since after the First World War. Just look at that. That's creating a huge demand which cannot be met. Now, the government, election year coming up, we had a budget response. They're saying, yeah, we're going to slow down immigration. we need immigration. The government's bringing people in, they're importing people because we need to create people to fill up the jobs. The baby boomers are leaving as they're retiring. And what's happening is the government has to pay the aging population, the health system, the pension system, and either you guys are going to have to pay more tax, and that's not going to keep the government in power, or they're going to have to bring more people in who are going to pay tax. And that's why it's doing that at the moment. And the next slide shows why I believe we've got really strong potential for our housing markets moving forward. Significant population growth. This is the suggestion over the next decade by ID demographers who advise government. And they're suggesting we're going to get 3.9 million people in Australia in the next decade. That's going to be because we're creating about 2.6 million jobs. And the sort of jobs we're creating are in general knowledge-based jobs, so there's more income as well. So if you believe that having a stronger population and a population that can afford it is going to continue on, and that's what the business plan of Australia is, that's going to underpin property values. And when you look at buying a house today or an apartment today and you think it's expensive, when I bought my first property in the 1970s, and I went halves with my parents, we paid $18,000. We took a $16,000 loan. I put $1,000 in, my parents put $1,000, and we didn't know how we're going to pay off that $16,000 loan. By the way, we got $12 a week rent for that, and we were excited. So the answer is we are getting a bigger knowledge-based society. The next slide just quickly shows how there's many more skill level 5 jobs. The Australian Bureau of Statistics shows, the next slide please, Christine, shows that the skill level 1 jobs, there are more of those. They're tertiary educated jobs, university degree jobs, and there's fewer of the middle class Australian jobs. We're transforming to a knowledge economy where people can afford to and are prepared to pay more. So if we go to the next slide, it actually shows what's happened to property values. If you look at the last 2 decades, overall Australian property values grew by 5.3%, but in the previous 2 decades, they grew by 8.7%. So some people are saying, hey, it can't keep going up like that. Property values is not growing as much as they did in the 80s and 90s. Our kids are not ever going to be able to afford property again. In the 80s and 90s, what happened a lot was that the next slide actually shows that what's actually happened is that there was very strong inflation beforehand, and that accounted for some of the strong capital growth of properties in the 80s and 90s, but there was also big finance changes. And Brett, you'll remember that it was much easier to get finance at bigger multiples of your income then than there are today. But there was also the introduction of Aussie home loans and other second tier lenders that made borrowing easier. It's not as easy today, is it, Brett?
It's not, but I'm also not quite as old as Aussie Home Loans is.
No. Well, in fact, the concept is the party isn't over. An element of the growth in the past was related to inflation, and we are going to have inflation, but probably around 2 or 3% over the next couple of decades. But in general, what's going to go on is that we're going to have, it's going to be a bit harder to get in the market, and there will be haves and have-nots. So what's ahead? There's lots of different forecasts, but if I could just show the next slide, if we could just go one slide further, please, Christine, which actually, these are what's ahead. I think our economic fundamentals for Australia are strong. We're going to do well. Interest rates will remain higher for longer. It's going to take a while for them to drop down. Borrowing capacity is likely to remain a little bit less, so it'll be harder for people to get in the market. But in due course, interest rates are going to fall. APRA probably should loosen its criteria to allow people to borrow a bit more, but population growth is going to remain strong. And we're just not building enough houses, despite the government's intention of us building 1.2 dwellings in the next 5 years. And because of that, there's no end in sight to the housing shortage. Who wouldn't have liked to buy the house their parents bought 20, 30 years ago at the price they paid? When you look back at 2024, if you buy your first home or your first investment or your next home, you're going to look back and say, hey, that was cheap. But in all the time I've bought properties for myself and for clients over the years, I've actually never thought, hey, that was cheap. By the way, at the end of this, a little teaser, I've got a first home buyer's guide that I'm going to give people. I'll give you a QR code to get that. But Brett and I have got a few things to discuss beforehand. If we could go to what the forecasts are, prices are going to keep rising, rents are going to keep going up. Unfortunately, some people will remain tenants for longer, maybe all their life. And our markets are going to remain fragmented. They're never going to move Brighton or away from the beach, or Toorak away from close to the CBD, and Cranbourne and Pakenham are always going to be a long, long way out. That doesn't mean it's not the best place for certain young families to live, but during the boom of the 2020-21 period, everything went up. Secondary properties went up. Main road properties went up. That's not the way it's going to be in the future. So your first home will not be your forever home. So I suggest you buy the sort of home that will be the stepping stone for better property growth in the future. So what's going to happen to property values? Oxford Economics, that used to be called BIS Shrapnel, have suggested that Melbourne is going to be one of the best property markets over the next 3 years. They're suggesting that Melbourne houses will grow 21%, units 20% over the next 3 years. And to be fair, much of that's going to happen in the next, not in the next 12 months, but in the subsequent 2 years of the 3-year period. I think at the end of this year, property values will be a little bit higher in Melbourne, but not a lot. But once people realise interest rates have reached their peak and are not going to go up, once they see an end in sight and that interest rates are going to go down, once there feels job security, and once the confidence, which Melbourne's lost its mojo, once the confidence comes back, these huge underlying fundamentals. So how do we help our kids into the market as my parents helped me? That's the question I want to ask. So there's a number of different ways, and Brett and I will go through those. But if we could look at the next slide, first of all, educate them, show them, talk to them, teach them about things. The apple doesn't fall far from the tree. Then you can gift them money. You can loan them money. You can go guarantor for loans with the banks. There are various other limited security loans. You can buy together, or you can buy a property in a trust and then give it in the future to your children. What I'd like to do is go through each of those, and Brett and I can talk about the pros and cons. But this show came up just recently from the investment bank Yardney, showing that currently a huge percentage of people are lending their children money. It's the bank of mum and dad, which, if it was such a real thing, would be a very, very big institution, somewhere between the 5th and the 9th largest lending institution. And this is suggesting that quite a few people are lending very significant amounts of money to their children. So could we go to the next slide, please? And Brett, maybe you and I can discuss this together, if that's okay. The first thing is, hey, real simple. They need some money, I'll give them a gift. What's the implications of that, Brett?
So from the perspective of finance, giving gift can be very simple. In instances where we are receiving gift as part of the deposit contribution, we're just getting a stat deck. We just need to state there's no interest on it. There's no repayments on it. It's non-refundable. Once that money is gone, it's gone. It's now the child's money. That can be a good and a bad thing. The good is it's very simple from a bank assessment point of view. It also means we don't need to factor anything in for the balance sheet or the repayments for the child, which is a positive. Just around that, I would probably go to one level extra and just want to look at why we're giving the gift. So I've dealt with all different scenarios, and some of it is just, I've got a lump sum and I'm going to give it to my child and they can do what they will with it. Beyond that, I've had a scenario recently where the parent did have a lump sum, they were giving it to the child, but they specifically did not want the child to then buy a super expensive property, take on a big loan, and live more ostentatiously than what they'd expected. Part of the gift was that you would use that gift as almost the full purchase price of the property. The child and his wife did take a small loan that they probably pay off in 3 or 4 years. But the parent had very specifically said, I'm not giving you this money so that you can go and buy something, some flash thing for $2 million. It might be that. It might be that we want to minimize the monthly repayment. We might be mindful that interest rates are quite high. We don't want to cause stress and anxiety for the child. Maybe we want grandkids in the next couple of years. We don't want them to have to delay that to the point where we're getting to an age where it's risky. Maybe we just want to remove the need for lender's mortgage insurance. So I would add, if we're going to give a gift, we just want to understand why we're giving the gift and make sure that if we give that gift, we're actually accomplishing that purpose. So
well, I think another factor really is that you've got to think in the back of your mind the very large number of marriages that break down. In the old days, when I used to see clients many years ago, I used to say jokingly, in my blended family, we've got 6 kids and statistics say 2 or 3 of them are going to get divorced, but I don't know who they are, ha ha. Unfortunately, now I do. And so therefore, I believe that this is one way, but I think there are better ways of doing it. And another way of giving them money is actually giving them a loan, Brett. And again, you may not even expect it to be repaid, but on balance, it actually shows that it is a debt that may have to be repaid if there's a family breakdown.
100%. So yeah, you're right. So this can guard against the family breakdown thing. And I've had instances where we have given the gift with the parent knowing it was a high likelihood, let's say, and we actually got the loan. The bank registered a mortgage on the title, and then we registered a charge on the title subsequent to the bank to guard against that exact thing. If we're doing a loan, it's a little bit different in a gift in that we still provide a stat deck stating what we're doing, but we then also have to declare if there's any interest. Is there a monthly repayment expected? Is there no repayment expected and we are waiting for the property sale to take a cut of what it sells for? Whatever that is, we need to declare it to the bank. And we do have in our provider loan column, so we've tried to make this table as simple and as readable as possible at a glance. Provider loan, we've got risks not viewed favorably by the bank. Now, just want to go into a little bit more detail there. So the most common scenario that I see is that we've got son and daughter, young professionals, income strong, 200, 220,000 per year of joint income is common. That level of income allows you to borrow probably $1.25 million. But having a deposit to buy at that level is an entirely different thing. And although it's possible to get to that income level but when you're 30 or something like that, it's not always possible to save up 100 or 150,000 in cash at that point. So in that scenario, our purchase price is determined more by our cash level than it is by our income. If we take a loan and we have to factor in a repayment on the loan, we're taking some of that income away, but we're adding to our cash. And so we're balancing those more. In that scenario, it's not a bad thing. We had the surplus income anyway. Let's utilize it. Let's get the cash and let's get that property that we want. It's always a balancing act though. So we want to know how much surplus income we've got. We don't want to obviously use all of that in the repayment and then go kind of too far the other way. So there's a lot of, there's a bit of balancing act there, but
I think the message I'm getting, Brett, is get advice before you do this.
Definitely.
Because there are implications. Speak to your accountant at Wilson Pateras, because sometimes there are tax implications, and speak to Brett about the finance implications before you do this. It's not as simple as it sounds.
It's definitely not. And just to add a little bit more, a few other things to think about, I guess, on those points. Firstly, is that if we're giving a gift, particularly it's a large gift, if it's coming from one, if there's a son and daughter buying together, sorry, husband and wife buying together, and where one set of parents is giving some cash, but the other's not, can be aware of the imbalance there. You can apportion property ownership. The banks will need each party to have minimum 25%. So you can apportion it to 99% and 1%, but the banks won't want to enter into a joint loan in that scenario. They'll need each party to have minimum 25%. So if one party is receiving a gift, they want to have 75% ownership of the title and 25% to the other party. That's perfectly fine from a titles office point of view, but the bank doesn't recognize that from the loan point of view. As far as the bank's concerned, all the borrowers are 100% liable for the debt together and severally. So It's just something else to overlay that with. It might be something that we want to look at if it's a particularly large gift. And then as well, just to add to that as well, there's also the issue of genuine savings. So some people might be familiar with this. Most banks these days will want to verify genuine savings. So if we come to the bank with a 5% deposit, which is the minimum that we can get away with, if all that money was gifted and we didn't have any money to put together, the bank views that as too risky of an applicant. They won't want to go ahead. So when we enter into a transaction with the bank with a small deposit, so 5, maybe up to 10%, they'll want to verify that at least that portion of the cash has been, that the applicants have shown that they can put that money away. So it can be savings, it can be, shares that we've been using as a tool to save up the deposit. It can be from paying rent, it could be from paying board. But if the applicants go in with no money, no deposit whatsoever, and we're just going to give them the 5%, we might, going back to what I said before, we might not be solving the problem of actually getting the money, and the gifted money might not be achieving its purpose.
Interesting. Okay, the next alternative is providing. If we could actually go back a slide, please, Christine. What about guaranteeing the loan? In other words, our kids have got a bit of money there, but maybe not the track record. Am I able to go to the bank and say, I'll actually guarantee it? Maybe I'll give you my home as security or portion.
Yeah, so we can. So there's two, when we talk about guarantees, there's two important factors that we need to be aware of. The first one's income. The second one is deposit or security. So in terms of income, we used to be able to, when I started doing all of this, we could use the parents' income through a guarantee to stretch how much we're borrowing. It wasn't something that we did, too commonly, but it was possible. That's no longer an option. The only time that's really acceptable now is for spousal relationships, which is not what we're discussing today. The other option is a limited security guarantee, as we've got on that table. And that is purely to address the issue of not having the deposit, not having the cash available to bridge the 20% deposit that the banks want. It doesn't allow us to borrow more. So if my income says I can borrow up to 800,000 and I need a certain amount of cash there that I don't have, I can get mum and dad's property. I can use that as a guarantee, not for the entire loan, purely just for the amount of cash that I'm short by. I can still only borrow the 800,000. I can't then go and, utilize all of mum and dad's property and go buy for 1.5 million.
So there's two elements to what a bank looks at. Serviceability is what you're talking about now, and also how much equity you're putting in. But they also want to make sure, as you've said a couple of times, that it's not just the serviceability, but can these people actually stick to a budget? Can they save money? Are they going to be a risk to the bank?
That's right.
Sometimes we think, okay, look, let's just go halves, which is exactly what I did with my parents when I first started in the 1970s. The lending criteria were very different then. I had to put a suit and tie on and go to the bank manager and beg. But that was different. There are advantages to that, but there's also challenges because you're jointly and severally liable for the loans. People don't always recognise that, Brett.
Yeah, that's right, for sure. And also need to be aware of consuming equity in a property. There's an opportunity cost that we need to be aware of there. So if we've given our title up to the bank, that's not available for other purposes, particularly when we're talking about this kind of transaction with a child. If we have a different kind of investment, we want to liquidate it, we can call an agent, throw something on the market, or we can log on to internet banking and sell our shares. But when we're going into a transaction with our child, we're not going to say, hey, I've got this good opportunity. I need you to move out of your house so that I can prepare for my retirement. So we definitely.
And of course, when you do sell, it's not your principal place of residence. So there's capital gains tax. But the joint and several liability, if I could just explain a little bit further, the bank sees that you're potentially liable for the whole loan. So therefore, it will decrease your serviceability on other things, not by the 50% that you've notionally got responsibility for. It's the fact that you could be responsible for 100% of the loan. And so therefore they take that into account, don't they, Brett?
Definitely they do. Yeah, definitely. They view each party as responsible for 100% of the debt. There's no way around that. We need to also be aware of, for all these scenarios, you know, the guarantee one's obviously relevant, the buying together as well. We need to be aware that the bank will, if we're putting something up as security, the bank has the option to call upon that. It doesn't mean that they would do so immediately. So this is a conversation I'll have often for specifically for the security guarantee, where we might have a guarantee that's $40,000 or $50,000. If the bank needed to call upon that money, if, you know, child's lost their job and has to move out or something like that, you're not just going to come home and find a for sale sign on your property. The bank's going to call you and say, do you have another means of repaying that money? And that's the first step that they do. So something to be mindful of. But in all of these scenarios, you'd be required to obtain legal advice separately, each party separately to the other, to go through all the ins and outs with a lawyer.
Okay.
Okay, so thank you, Michael. So I'll take over from here. But Michael, I just want to say as well, if anyone has any questions, the whole point of what we're talking about today is to provide useful, usable information. So if you do have any questions, if something you know, flickers in your mind, it's probably flickering in the mind of other people on the call as well. So please put the questions in the chat, and I've got Christine here who'll read them out as we go. We'll also have some time for Q&A at the end. This slide, I wanted to start off by just trying to provide a really simple table of purchase price and what's needed to achieve that purchase price. I'm very mindful, particularly for young people at the moment. There's a lot of noise in the media, on social media as well, that it's not possible to buy a property. And while that can feel like the case, and it probably is if you're living in inner city Melbourne or Sydney, there are tools available at the moment that have made it easier in the last few years to do so. Not saying it's easy, but just easier than what it has been. So we can see from this table, you know, maybe 400 and 600,000. Maybe we're not buying a whole lot in capital cities at the moment. Maybe 700 and 800 is more like it. But the incomes that we've got there, 140, this is a joint household. I've just taken a basic scenario. We don't have any kids. We've got one credit card with a reasonably small limit. That's doable. 63,000 for a 700K property in terms of deposit. Doable, not saying it's easy, doable, maybe as well with a little gift from mum and dad. So these things are possible. What I'm going to do over the next few minutes, though, is just talk about each of these things. So the cash contribution that we've got, the income that's needed, it's very hard to just give a fixed answer. And I'll go through and explain why, and then we'll come back to this slide. So Christine, if you can please go to the next one. Thank you. So when I prepare a loan, so when I have a call with a client or a meeting with a client, and I go through and ask you what you do for a living, how many kids you've got, what your car loan repayment is, and all that stuff, this is what I'm looking at. And I apologize, I know it's not the prettiest thing to look at, but this is basically one long list that I've had to chop into 3 to fit on the page. Now, if you look at the first column, so the first number next to the bank logo, so we've got First Mac top left, max capacity 799,000. Based on the previous scenario I gave you, this is how much First Mac are quoting as the max loan. So that scenario was 2 PAYG applicants, 80,000 a year each, no kids, living in Melbourne metro area, and with a 5K credit card. Okay, that's the identical information for every bank that's listed here. And we can see how much the variance is. So if you look on the last column, right down the bottom, Gateway Bank, they're quoting 664,000. That scenario is basically the easiest possible scenario, the most simple basic scenario that I could put in front of a bank. And we've got a variance of, what's that, 140,000 there, right? So why is there a variance? Living expenses is one of it. So if you look for each of the columns here on the right-hand side, we've got HEM expenses. So if we go back to First Mac, our first lender there, the last number in the First Mac column is 3791. That's the minimum amount that First Mac require for living expenses. Now, that number is calculated by where our applicants live, how many kids they've got, what the total household income is. And we can see that that's different for each lender. That variance grows as the scenario becomes more complex as well. Like I said, this is as simple as a scenario as I could put in front of someone, and we've still got a variance of 140,000 here, okay? If we can please go to the next one. So this is more representative of the kind of scenario that I see, okay? So this, I've just gone, same thing, I've changed our first income earner now has a bonus component. that vary slightly year on year. Our second income earner is now self-employed. They pay themselves a bit of a salary. The business makes a little bit of a profit that's retained in the business, and they've got a car that's under the company, which means we can claim the depreciation. Great for tax. That impacts our borrowing capacity. We've also now got 3 children. Okay, so our variance now, we've got at the top, so Liberty now are quoting that they'll lend us 1.1 million, and all the way down the bottom, second from the bottom, First Mac have now gone from the top all the way down to the bottom, right? The variance, so ING down the bottom, 400,000 to Liberty up the top. So the variance is almost 3 times. Now, I'm very aware that this, as someone who's, even as me, an experienced lender, this kind of variance is crazy. For someone who doesn't have experience in the property market going in as a first home buyer, number one, there's no way that you could know this variance exists unless you actually go through and look at it. There's no way also that you could know why it exists. Okay, so I mentioned before to you that the variance was because of interest rate, it was because of living expenses. Now, as the scenario grows more complex, we're now overlaying that with all the different policies that the banks have. So they all might have different minimum repayments on credit cards. So the more credit card limits we've got, the more that they're going to part. We might have different policies for bonus income. So for example, most banks would have a 2-year average on bonuses. Some would then overlay that with, if the most recent year bonus is lower, then we're just going to use the lowest years. Some would only take the most recent years. They don't even care what you earned the year before that. We might have, not first home buyers, I don't expect there to be rental income, but rental income shading is a big one. Some will shade it at 90%, some will go down to 65%. The others are all in the middle somewhere. We might have for self-employed clients, 2 years financials, 2 years average income is the norm. Then that's overlaid with some lenders that would only say, if the most recent year is less, we're going to take the most recent years. If the most recent year is higher, we're only going to take an uplift up to 30%. So for example, this is a really common one. I've started my business in year 1, I've earned 100 grand. I've fully worked all of year 2, and I've now earned 200 grand, which is representative of my income capacity. It's representative of what I'm going to earn moving forward. The bank would only take 130 grand, being 100 grand of the first year plus the 30% uplift, even though I'm earning 200 grand. Again, how do we know this is the case? How do we know that all the banks aren't doing this? How do we know which ones do it? Overtime is a big one. If we've got any nurses or paramedics on the call, you guys really need to go deeper into this. So most places will take a base rate of income, and then they'll take the overtime on top of that, shade it down to 60%. Nurses, you guys have overtime, you've got different hours, nights, weekends, you've also got your salary packaging. All of these things are all treated differently within each bank, and obviously each bank separately as well. So you might have some that just say, if you're in that field, we know your income's reliable, we're just going to take 100% of all of it. We don't even want to break it down, all the way down to banks that, you know, treat that kind of income similar to like shift work or warehouse work or something like that. We also have shares, government income. They're all shaded a little bit differently. I'll come back to that, Christine. And again, they're all shaded differently based on the different lenders. So it's incredibly difficult to know where to go to know how to navigate all of this. But the most important thing I would say is just to understand the difference. So in this scenario, I'll take 2 what we'll call normal lenders. We've got NAB, they're quoting 955,000, and Macquarie is quoting 855,000, right? So if I spoke to both of those banks and I got both of those numbers, I'm new to the industry, I don't know why that difference exists. I then also don't know which one to trust, which number's right. Obviously, I'd want to go to NAB. They lend me more, there's more freedom there, there's more options, but did they enter something incorrectly, or is Macquarie's the right number? Is it because they have a policy that's not, you know, conducive to my application? We don't know. And the important part of it is that the bankers at each of those places, while they can speak to their own policies, they can't speak to differences between other banks because, of course, they don't know them. It's hard enough staying on top of the policies for one bank, let alone multiple banks. And it might be that the Macquarie Bank is the right answer. It might be perhaps we had a high bonus the most recent year with NAB, so we've input that, but we know that that bonus was a one-off and we don't expect that to keep coming in moving forward, in which case it might be that Macquarie is more suitable for us moving forward. So there's a lot that goes into it there. If I can please go back 2 slides, Christine. So coming back to this slide, you now see the income needed for that purchase price. It's an estimate, but it's very different between each bank, and it's very different based on each individual scenario. So while online guides and online calculators are good, they're not a replacement for going in. And when you are ready, when you feel like you're ready, when you're getting to that savings level and you've been looking at the market and you think you're ready to go for a property, I definitely recommend that you chat to someone as early as possible, just to make sure we're managing what our expectations are. It might be that we can borrow more and, the properties that we want are going to be attainable for us. But if that's not the case and we're going to go the opposite, we need to find out as early as possible. Hopefully we can do something about it. If not, we just want to be able to adjust the properties that we're looking at. In terms of, sorry, just go back for me, please. Thank you. In terms of what we can do, so with income, there's not a lot we can do. We might be able to do things like remove a car repayment. We might be able to sell a car, downgrade. We might be able to reduce credit card limits. All these things help us to borrow more and stretch the income out a little bit. It might be a timing thing. I've got a client I dealt with recently who was a train driver, a lot of overtime, fluctuating income, and we're going to take a 6-month period. So it was worth us waiting a couple of months to have the best 6-month period on his pay slips so that we could borrow the amount that we wanted. So timing is an issue. Also for self-employed clients, if we're going to use 2 years financials, if we're in a window where maybe the financial year is about to wrap up, we've had a really good year this year, or we've had a year that's more representative of our income ongoing, might be worth waiting for that financial year to close, get the financials done as quick as we can, and then go to the bank with that application. So there's a few things we can do with the income, but not a huge amount. The cash contribution, though, this is probably what more determines our purchase price, just because this is the harder one to attain. So Christine, if you can please go forward 2 for me. One more. So the first thing that's available to us, the first homeowner grant. When I started doing this 12 or 14 years ago, the first homeowner grant was huge. It was a lot more. Firstly, it was a larger amount. It was 20K. At the moment, it's only 10K. But there was a lot of construction going on there and a lot of first homes being put up. And that was how we qualified for it. Property prices were a little bit lower as well. A lot more transactions at kind of 500 to 600,000. And so it was really popular. We were putting them through very, very regularly. These days, that's not really the case. The first homeowner grant is 10K. It's up to 750,000. So plenty of room there in terms of purchase price, but it has to be a brand new property or newly constructed dwelling. And that's probably where there's fewer people going into those as first home buyers. Yep, next one. The other one that we've got, so this is more recent. I think we're closing our 3rd year of having this available, the government guarantee scheme. It might be the 2nd year. This is really good, and I'm a big proponent of this scheme. Basically, the banks want us to have a 20% deposit to go into a transaction. So if we want to buy for $1 million, they'll lend us 80%, 800,000. They want us to put in 20%, 200,000. They will lend us more. They'll lend up to 95%. But if we're going to borrow more than 80%, we need lender's mortgage insurance, which is the bank insuring themselves at the cost of the borrower. The government guarantee scheme is made to specifically address this. So we still need to put in 5%. We still need to pay our purchasing costs, our stamp duty, or whatever else it may be. But the government will guarantee the difference between the 5% and the 20% that the bank wants. It's for first home buyers only, or people who haven't owned a property in Australia in the last 10 years. We have to be a citizen or a PR. So unfortunately, and this is a situation I had recently, any New Zealand friends that we've got on the call today, you don't qualify. Even though you come here and you can stay here permanently, you actually don't qualify this. You have to go and specifically get a PR visa or a citizenship to be able to qualify for this. Don't ask me why. Absolute madness. That's just the way it is, unfortunately. There are price caps. So for us here in Victoria, you can see on the right-hand side there, 800,000 in Melbourne, 650 in the rest of the state. And importantly, the qualifying criteria right down the bottom there. So this is probably the important thing, because this is where for us to be able to buy, especially at 800,000, it's probably unlikely that we're fitting within this, or at least it's going to be close. 125,000 single income, 200,000 joint income. That's taken from the previous year's notice of assessment, not current pay slips. So if we are close to it, it might be worth applying now, getting a pre-approval now, confirming our space in this government guarantee scheme. Once we lodge a pre-approval, we can confirm the space. We've got that for 90 days before we go through and submit another tax return, because that might disallow us if we've earned too much. Similarly, if we had a a one-off great year last year and we earn more than what we're going to this year, it might be worth waiting until we've submitted our tax return for 2024 and then applying for our government guarantee scheme after this. Next slide, please. So this first slide, what I'll go through, and I'll just talk about the cash that we would need in both scenarios. So the first scenario, we don't have the government guarantee scheme. So we earn too much, we're buying for too much. For whatever reason, we've owned property before, for whatever reason, we don't qualify. This would also be the case if we were buying a property that we're not going to live in. So if we're living in the city, but we're going to buy a regional one and rent it out as an investment, these numbers are going to be relevant for you. We can see the purchase price on the left. So up to 600,000, needing 62,000 total. A big portion of that is the LMI, lender's mortgage insurance, at 27.5. This is assuming we've only got a 5% deposit, which is the lowest needed, so 30 grand. If we can get to 90% borrowings, so if we can have a 10% deposit, our LMI actually halves. So at that 90% threshold, it doubles. So in that scenario, at 600,000, we would need 60K to put towards the property itself, but the LMI would only be about 13 grand. So just something to be mindful of. But we can see, as I made the point before, especially if we're looking at kind of that 700, 800,000 purchase price, which is probably more common for first home buyers, the income side of things, probably reasonably easily doable with joint incomes. The cash, 120,000, obviously a lot bigger ask. If we do qualify for the government guarantee scheme, though, if we can jump forward one, please, Christine, thank you. Our LMI becomes 0 on all of these. The other numbers are the same. So now say 800,000. So we needed 120 grand before. We now need 83. 83 grand, I'm under no illusions. That is not an easy number to come by, but it's also only 66% of what it was before. So this government guarantee scheme is really good. It's really helpful for those that do qualify for it. It really takes the pressure off. Even at $1 million, 50 and 55,000 as the deposit amounts that we need, a lot easier than 155,000, which is what it was before. Okay, so in summary, a few key points there. Michael made the point about the overall property market expected to maintain its value with a moderate medium to long-term increase here in Melbourne. Again, it's going to be a little bit different for each of the capital cities, but I think the takeaway from that is we're not needing to urgently jump in now. We also don't need to be worried that if we do jump in now, we're going to have a reduction in value of the property and we're going to be stuck with an asset that's worth less than the loan in the near future. The government programs available at the moment are really good. The government programs stack as well. So the stamp duty reduction, the government guarantee, and the first homeowner grant, they all stack. If you qualify for all three, you get all three. We don't have to choose one or the other. And we can also couple that with help from mum and dad. So where we spoke about having a 5% deposit, we can have the government guarantee kick in the rest. And if we do have stamp duty, mum and dad can help with a gift or something like that, or a loan to cover the stamp duty amount. We're not going to breach our genuine savings obligation in that scenario, because we would have still saved the actual 5% deposit for the property. Bank is happy, that's a tick. Government's happy because we put the 5% in, and then we can have a gift to cover the stamp duty if we're buying for more than 600,000. The other thing, do your research. I know it's not easy. I know it's very it puts a lot of time pressure on us to go and speak to a lot of different banks. And even then, which banks do we go to? Myself as a broker, all other brokers, this is what we do. So we have these comparisons. Myself and anyone else that you speak to, I'm sure will be more than happy to go through those numbers with you. And as I said, a key component of it is, it's not necessarily that we want to go to the bank that lends us the most or the bank that has the lowest interest rate. It's just that we want to understand why these differences exist. If I'm going to pay 0.25% higher, it might be for good reason. It might be that, say, for example, ING have a very low cost bank. They deliberately have a very low cost bank. And the way they've done that is having very thin credit criteria. So if we don't qualify for that, that's perfectly fine. It doesn't mean we're getting ripped off by paying an extra 0.25% somewhere else, but we should understand why that's the case.
Could I please disagree with you, Brett? Don't do your research. get somebody else to do the research for you. The bank with the blue logo is not going to tell you that the bank with the yellow logo is going to be able to help you more. I know that a significant amount of work you do to put in to help your clients, Brett. We've got a few clients together and you've done a lot of work and helped them significantly. A mortgage broker actually doesn't cost them anything. And I wouldn't call you a mortgage broker. I think you're underplaying yourself. You're a finance strategist, because I think you've actually just shown that there's a strategy behind it as opposed to just getting the cheapest loan. So if I could please disagree, don't do your research, let Brett do it for you.
Sure. Yes. Thank you for that, Michael. I'm just looking at the questions here. So John has asked.
Could I just, before we go into the questions, remind people, could Christine just go to the slide with the QR code? Because I know some people are going to leave before we finish. Just go up one more. And if we tell you at the beginning of webinars, seminars, hey, turn off your phone. We didn't even do that. But if you just click on that QR code and put in your details, two things will happen. Firstly, you'll get my regular property update newsletter every day with a whole lot of expert advice. Number two, you'll get a special report. And only after speaking with Brett a few minutes ago, I thought, hey, what we should do is give you one specifically for your requirement. So it's a property home buyer's guide. And it's going to give you a whole lot of things to think about as a home buyer, whether you're a first home buyer or established buyer. So just click on the QR code, fill out your details there, please. And then you're not going to keep getting annoyed by us. You can always unsubscribe to my daily newsletter, but at least get the benefit of getting that home buyer's guide. Sorry, Brett.
No, that's okay. No,
that there. And now let's quickly go to the questions.
Yeah, so John's asked, currently I'm starting to look for regional property buying land and building. Looks to be super prohibitive. And as a single person, I have no hope of getting to the $500,000 or more loan. If I'm looking at renting, how much would that possibly affect lending value? So if you stay paying rent and you buy a property and in turn rent that property out, there are a few considerations. Firstly, the rental that you pay is taken at 100% by the bank. So if you're paying $2,000 a month, the bank takes a $2,000 a month expense out of your income, but they don't add 100% of the income that you'll earn for your property. So they might take, and this is what I mentioned before with rental shading. Some banks will take 90% of the amount that you give them, and then they'll ask you to declare what expense you're going to have on that investment property per month. So I'll take 90% of your rental income and they'll add another expense for maintaining that property. Some banks will take 65% of the rental amount and that's it. They'll just assume that the expense is factored in there. Others are in between. The most common, I would say, if you're just going to walk into a bank, most likely the policy that you're going to see is that they're going to take between 80 and 90% and they're going to ask you to add a rental expense. Most banks as well will factor in tax gearing. So if there's an advantage there in terms of interest charges, they will factor that in and offset your income. The degree, how that's important will depend on what you're earning, what the interest charges are, and how effective that tax gearing is going to be. So it's a little bit hard to ask, but yeah, it's definitely a scenario that has a lot more moving parts, John. You're spot on there.
Also, be cautious. Why are you buying in regional Australia? Are you buying there because you want to live there? Really good question. Are you buying there because that's all you can afford? Well, maybe that's not the right answer, because if you're talking about the sort of sums you're talking about, buying land and building at the moment in general, one doesn't equal two and a bit. It actually probably doesn't add up to. You can usually buy established properties at the moment, just because of where we are in the cycle, cheaper. By the way, there's one other area of helping your children into the market we didn't really have a chance to discuss, Brett, and that is buying a property in a trust that you control and allow your children to rent from there with some aim in the future of passing this on. It's a very different scenario. It's something that you should speak with your tax advisor at Wilson Pateras about. But interestingly, all of my 6 children live in fantastic accommodation they couldn't afford if we didn't own it, but it's going to be theirs in the future. But there's actually certain tax benefits and also bloodline protection benefits as well. So that's not them actually owning a property, but it's another way of doing things.
As a father
Can
of
I
a
just
5-year-old, I'll give you a minute's silence in respect of having 6 kids as well, Michael.
No, well, I've had 4. My wife's had 2. We've been together 27 years, so it's a blended family.
Right.
But yes, and 12 grandchildren out of that, Brett.
Well done. Vicky,
Uh,
the figures are on joint applications. What about a single person wanting to buy a house? So, Vicky, everything I ran through, I spoke about it in terms of joint incomes, etc. That was purely pragmatic because that's the most common scenario I see. But all those incomes, it's just a total combined income. The figures are slightly different because of the tax brackets and because of the living expenses if it's single or double. But honestly, it's not enough. When I'm speaking with broad 1 or 200K brackets, it's not enough to worry about. So the figures are still roughly correct. Having said that, more than happy to go through a scenario with you if you wanted to afterwards. And then Catherine.
Catherine has actually asked 4 parts. Can I go to the bottom bit? Catherine,
Of
you're
course.
talking about buying a new apartment and you're concerned there'll be no or negative capital growth. This is not the time to give property advice, but I'd be very, very careful about buying new apartments. There's challenges with those. Now, again, if you talk about the price bracket, you're talking about the cheaper sort of apartments. You're looking at the 550, 600K. Most of those were built for investors. They haven't done well over the long term. The buildings often have excessive strata fees. And there are, as I'm sure you keep hearing about, challenges with water problems, structural problems, cladding problems in Melbourne and Sydney. There are other problems. In some ways, they're built out of paper mache, not the bricks and mortar solid things that were built. So older style, family friendly apartments, in my mind, Catherine, make good investments. Why I'm saying family friendly, if you can buy in a good area of Melbourne, close to the, interestingly, domain.com.au, the website came up with 160 suburbs in Australia where properties are still cheaper than they were at their peak. And interestingly, there's a whole lot of them in Melbourne, including the ones around the CBD, Carlton, Brunswick. You can buy some good older established apartments in blocks of 6 or 8, those old walk-up ones that are solid, that have got a track record that I think are more likely to give you capital growth as the next round of new apartments come on board and become much more expensive. When the next round of new apartments eventually start getting built, they're going to have to sell at 40 or so % more than current market values. That's why very little new developments happening. So sorry, I jumped in there because the question is buy them a flat. Yes, no argument about that, but not a new one. Be really cautious with those.
Yeah,
I'll
and I think
answer the other parts of the question.
yeah, sorry, Michael. I was just going to say, it looks like Catherine, I don't know if I'm reading this correctly, but you're buying it without a loan and then charging them rent so that they can pay you back. If that's the case, no bank's going to be involved, so the banks aren't concerned. If I'm reading it incorrectly and you meant that you would borrow from a bank and then have them in there and they're making your loan repayment for you, there's no issues around that. There's certain scenarios like through a self-managed super fund or something where that could be an issue, but assuming you just mean your personal name, it's fine. You can charge them whatever you want. It's not an issue.
One of the thoughts, though, Brett, is that a lot of people want this. My kids are going to go to university. I'll buy an apartment near there. My kids are going to go to Sydney. I'll buy them an apartment there. Sometimes it's better paying somebody else the rent for your kids and buying yourself an investment grade property rather than buying a secondary property that's going to have a short-term 3-4 year lifespan. So think long-term. Think about what suits your long-term goals as well.
Yeah, sure. And I see that comment, Catherine. Yep. So no issues there. Belinda Law asks, is buying property using a trust and then renting it to children very expensive administratively and only worth the trouble if the trust holds many properties? You're probably well placed to answer this, Michael.
Well, okay, there's a one-off cost of setting up a trust and there are minimal annual compliance costs. No, it's not expensive. In fact, most of the successful investors we work with own their assets in trusts rather than in their own name for asset protection, for tax purposes, and also for flexibility and for intergenerational wealth passing on as well. You've got to get tax advice from your accountant at Wilson Pateras, but I have not found it an issue. And you've probably heard the old story that wealthy people own nothing but control everything, and they do it through certain structures, companies, trusts, and self-managed super funds.
Yeah, I would definitely say it's worth a conversation with your accountant for sure. There's a cost involved, but my opinion, I wouldn't say it's prohibitive if you're actually looking at going through that scenario.
Not going to change the long-term aim. No.
Yeah. That's all the questions that we've got. I thank everyone for coming along. I really appreciate it. Hopefully it's been somewhat useful for you. I will give Michael one last chance to throw any other comments in that you would like to, Michael.
No, other than just reminding you, who wouldn't like to buy the property their parents bought 30 years ago? And by the way, they thought it was very expensive at the time as well. I see a window of opportunity in Melbourne in particular, only because Melbourne has underperformed, because we've got problems with our state government, with the local economy, lack of confidence, investors are stepping out, but the underlying fundamentals of Australia are good. So have a long-term focus. Don't worry about where interest rates are going to be in 3 months or 6 months. Have a look at where the property market's going to be in 3 or 6 years' time.
Definitely. And thank you again for attending, everyone. My contact details are there. Please reach out. Any questions, any scenarios you'd like to walk through. I do enjoy it, so I welcome any contact. Thank you again and have a great day, everyone.